In this video, I want to talk a little bit about the cash conversion cycle. And we'll do some terminology updates first. Essentially, what we need is three variables. The first variable we need is what's referred to as days carry inventory. On average, this is the number of days that it takes to for inventory to sit on the shelf. So there's a couple of ways this spreadsheet works. If you already have the ratios, you can plug the ratios into these yellow boxes over here. In this case, DCI's days carry inventory. However, if you have the average inventory of the company and you know what the cost of goods sold is, if you're working right from a spreadsheet or a financial statement, and then that will calculate the days carry inventory. And you can see here it's a formula that says, look, if these things are true, then it plugs in, does a formula. If not, it uses this cell here, which is this E9. So in this case, it shows that this company roughly takes 31.8 days to convert its inventory into a product. That is, you acquire it and then it is sold. Average accounts receivable, DSO, is the days sales outstanding. Sometimes this is also called average collection period. Talks about the average number of days it takes for our customers to pay us for the products that they buy. So the formula, again, if you look at the formula, it's the average accounts receivable, and then it's divided by the average sales per day. So in this case, it's 21.29 days is on average how long it takes for our customers to pay us. The third variable is days payable outstanding. And while I'm thinking of it, you can see these yellow boxes usually indicate some form of a comment. So if you hover over one of these forms, it'll give you some information about that line item. So days payable outstanding is the average amount of time that it takes for us to pay on our bills. In this case, it roughly takes us 25.89 days to pay on the inventory that we ultimately purchased previously in this days carry inventory. So that provides us then with some formulas. Operating cycle. And as you can see here, it says this is the average time it takes from the time of purchase of materials to the receipt of cash from sales. It is simply the addition of days carry inventory to days sales outstanding. So in this case, it roughly takes us 53 days from the time we buy inventory to the time we receive money for the inventory. The cash conversion cycle then is this operating cycle. Subtract from that the time it takes us to pay. So in this case, the operating cycle is 27.20 days. So for us to understand the concept here, think about the business cycle. You buy something, you sell something, and in the end, you obviously have to pay that something off. You have to pay for buying the inventory. So it's a cycle. It takes roughly 27 days for this cycle to complete. Now, management wants to try this to get this cash conversion cycle as close to zero as possible. In fact, very low negative numbers might actually be beneficial to the company. Essentially, that would mean that it received its money before it actually paid for the product. And I guess in the optimal, you'd like to say, I would like to, when I receive money from my customers, that's when I want to pay for the inventory. That way you're not out of cash for any period of time waiting for payment from your customers. If the number becomes too negative, though, right? If it becomes too negative, that implies that it's taking us a very long time to make payment on our payables. So a little negative is okay. As this number gets more and more negative, it could be indicative of slow payment on behalf of the customer, of the company. So again, that's the cash conversion cycle. Again, if we wanted to kind of think about what would happen if I had the numbers, if you type numbers, let's say it's 40 days is the days carry your inventory, then days sales outstanding here, let's say that's 35, and in this case, let's say this is 75. I'm sorry, I have to convert to get rid of these numbers. Sorry. I was wondering why that wasn't working. So if you get rid of those numbers, and now here we have our average operating cycle is 75 days, and our cash conversion cycle is exactly 0. So we are exactly matching the income of cash to the outflow of cash, which is ultimately our goal. Hopefully this cash conversion cycle worksheet was helpful.